Welcome to the Tough Decisions Network. This is our special Saturday edition called Step Up Your Game with Dan. I'm your host, Dan Hanford, and I'll be discussing topics to help you make better decisions to increase your productivity, increase your sales, and improve your overall marketing. Visit toughdecisions.net to sign up for our free weekly entrepreneur email. Before we get started, let's hear from one of our sponsors. Have you ever thought about investing in real estate, but find yourself so busy that you don't have time for it? Do you have FOMO, which is the fear of missing out? At HanfordCapital.com, we help investors with passive real estate investments that project better returns than traditional investment vehicles such as the stock market. If you'd like to find out more about our passive real estate investments, visit HanfordCapital.com. That's HANDFORD Capital.com. We will jump on a call with you to discuss your investment goals and to see if our investments are a good fit for you. This advertisement is not to be construed as an offer or recommendation to buy or sell a security. Visit HanfordCapital.com.
On the podcast with us today is Garrett Gunderson. Garrett, thank you so much for being on the podcast with us.
Dan, thanks for having me, man. I love doing this.
Well, Garrett, I want you to talk a little bit about your background and where your current focus is right now.
Well, I grew up in a small coal mining town because my dad, grandfather, even great-grandfathers were coal miners, and I've never stepped foot in one. I started a car detailing business servicing some of the surface vehicles from the coal mine and won the Young Entrepreneur of the Year. That came with a cash, award, and I wanted to invest it, partially because I wanted to get out of the town I was growing up in and get to what I thought was the big city, at that time, Salt Lake City, Utah. So that led me down a path of trying to figure out how to invest the money, and got offered an internship, which was kind of a glorified way of bringing friends and family to get peddled mutual funds and life insurance. But thankfully, the market started to go down in 2000, and I got really serious about my journey on finance and started flying somewhere once a month to learn from other, the people that I thought had the depth of expertise and figure out what wealthier people were doing, because I didn't know a lot of them at the time, and used kind of my age of being young as a way to get in through a lot of doors to have people mentor and teach me. And one of my professors in college was he managed $5 billion in municipal bonds, and then became a teacher afterwards. So I just had some really good kind of early exposure. And rather than being a normal, put money in the market kind of advisor, I decided to do what's more guaranteed and capitalize things immediately for people, which was, could I save them on tax? Could I save them on interest, on non-performing investment fees, or duplicate coverages or costs with insurance, and help them keep a lot more of what they make? And so that became what I was obsessed with. And how do we create velocity with their money instead of accumulate with their money? How do we get, more liquidity and access to pounce on deals when they came along? What could we do to get them to grow and invest back into one of their greatest assets, which was their business? And so that's really what my life was dedicated to on the professional side at that point. So,
well, I want to ask you a little bit about some of your dealings with some of your higher net worth individuals, because I deal with some high net worth individuals, and I had one recently that I was talking about some of the multifamily real estate investing that we're doing. And we do a syndication model where we bring in multiple investors, and I'm sure you're familiar with that particular model. But one of the guys that I was talking to, he said, I talked to my accountant about this, and he didn't have any idea about this. And so why doesn't my accountant know about this stuff? One of the things I mentioned to him is like, well, because your accountant doesn't make as much money as you do. You can't ask somebody that doesn't make as much money as you, what do you do with that kind of money? Because they don't have that kind of money to make those decisions.
Well, let's face it, we can't expect accountants to be miracle workers where an accountant's main job is filing your taxes and making sure you've maximized your deductions. But that's not where the biggest tax game is. Tax attorneys and even corporate attorneys help people reclassify income, and they know about tax arbitrage, which is the much bigger strategies out there. Tax arbitrage is anything like when you can buy something at a deep discount at book value, wait and donate it at appraised value. It's the exit strategies from a business like charitable remainder trust or caps trust or, ESOPs. I mean, if you're familiar with any of these kind of things as a listener, or it's where they start to help people move from active income from a tax perspective to passive income on how it's classified, or from ordinary income, which is a higher tax than capital gains, and transition there, or even taxable to tax-free. But Tax arbitrage is anything from historical easements, conservation easements, art donation strategies. There's just so many things out there that no one individual can be an expert in everything there is in tax. And reclassification strategies are much more about the attorney. And so, yeah, if you have an accountant that's on their heels and they're very reactive, that's a problem. But don't confuse an accountant that files taxes and does bookkeeping with a tax strategist. Those are two very different people with two very different ways of looking at the world. And so it's a commonality I hear amongst so many people out there that are entrepreneurs or investors is, why haven't I heard of this before? And it's like, well, you might need up to 4 people on your team. You might need someone that's a CFO, bookkeeper, or controller, depending on the size of business, CPA or tax strategist, a tax attorney. And if you own a lot of real estate, you probably need an engineer that can do cost segregation analysis, which is a way to accelerate depreciation. So, that's part of the thing. And I've got a simplified framework that makes all these complicated, really cool sounding things become a lot more manageable and digestible so people can implement them.
Well, I want you to talk about that because you basically have hit just about every one of the things that I was getting ready to bring up with you to dive into. So can you go through that simplified framework a little bit with us?
Yeah, I think that the oversimplified and mismanaged framework is two things I call tax traps out there in the world. One is when people defer and think they're saving tax, you're delaying tax. Be really clear about your exit strategy. Be careful about the seduction of a retirement plan, especially if you're a real estate investor, because retirement plans take a capital gain asset like real estate and turn it into ordinary income. You're going the reverse way and you lose a lot of your depreciation options and deduction options. The second thing is, don't just spend $1 to save 37.5 cents. Don't go get an expense just to save taxes, like doing a Section 179 on something that you didn't need anyway because it's a good write-off that year. Because once you know tax arbitrage, once you know reclassification, why would you spend $1 to save 37 cents if you can spend $1 and save $2, for example? So those are the traps. Here's the framework. 3 main pieces, silo 1, 2, and 3. 1 is the team, 2 are the deductions, and 3 is the reclassification. The team consists of, the 4 things I talked about: bookkeeping, tax strategist, tax attorney, and engineer. If you don't own a building, don't worry about the engineer. If you're doing less than $1 million of revenue, don't worry so much about the tax attorney. A corporate attorney will do. And then everybody, I think, deserves a tax strategist, because if you try to do it on your own, you're almost certain that you're going to overpay taxes, and 93+% of people are overpaying on their taxes. And that goes up now that we have 199A that just came out with Trump tax plan. My guess is 100% of people, for the most part, are going to be overpaying taxes as we decipher and wait for some of the rulings to come down from the IRS. So silo 1 is you build a team. You meet with them proactively, which is once a quarter. And every 3 years, you get a different set of eyes, because you can go back and amend returns and get money back. Like you can amend if you've never heard of Section 199, or you don't know about research and development credits or domestic production credits. That's something you can go back and get if you missed it, because it's not about the expenses you had. It's about the time that you spent and whether you got the credits or not. The second silo is deductions, which is simply, how do you turn your expenses in life into tax deductions? You ask, how does this relate to my business? And you document it well. Whether that's paying your kids in the new tax plan, you can pay them up to $12,000 if they're 18 or under, tax-free, and it's tax deductible to you. Or whether you employ the Augusta rule, where you use your home and you rent it out for 14 days a year to your business, you get to write it off as a business expense, but then it's a 100% tax-free income to you personally if it's 14 days or less. That could be hosting something for clients, vendors, employees. I mean, whether it's home office deductions you take, whether it's, I don't know, there's so many deductions out there, but that's kind of the less powerful thing. The third silo of reclassification is you choose the right corporations, how you pay yourself from the corporations. You learn about structures like captive insurance agencies as you get more successful. You learn about the things I mentioned before, because charitable trust, caps trust, ESOPs, you got to know your exit strategy if you own a business or a piece of real estate way before it's time to sell, because it might be the difference between paying twice as much in tax or even paying nothing in tax because of legal ethical structures that have been around for years and years and years, that if you wait till you have a business broker or letter of intent, you might not be able to utilize some of those. So really that third part of the reclassification, we can spend more time and give what the strategies are, but just knowing the framework, proactive with the team, take your deductions or take your expenses and see how many of them can become deductions and go through everything that you do. And then third, reclassify your income from the types of corporations you choose, how you pay yourself, where you flow your money through, and what your exit strategies are. And even if all that's maximized, then you can look at the tax arbitrage things, which are where the biggest tax savings are. And arbitrage sounds like a pretty fancy word. It's just that you're getting more than $1 for every dollar that you put into it, where most deductions are deductions instead of credits. Like you put in $1, you get 37.5 cents back, but you now lost, 62.5 cents, because it doesn't make sense to let the tax tail wag the dog. I think the game is no one shrinks away to wealth. Your greatest tax shelter is to always earn another dollar. So Dan, I'm not doing a good job as a guest. I'm not even letting you interview me. I'm just like going off here. I'm sorry about that.
No, that's great. I love it. So I've been making notes as we're talking. I'm going to be a little bit selfish here and dive into a few things, but I want also listeners to understand that you have a book, right? You have a book called Killing Sacred Cows. In that book, you dive into these topics, correct?
I actually don't. In Killing Sacred Cows, I wrote that, and it came out August of 2008, became a New York Times bestseller. It helps you detect the 9 most subtle yet destructive financial myths that people have bought into. And once you detect it, you know how to avoid the landmine. I look at it as a permission. It's like a book that gives you permission to succeed, permission to produce, to get rid of like the thinking that's been handed down since the Depression era that still plagues people's minds. So it's very philosophical, and it doesn't put all the pieces together, but it does help you, grow a lot more and avoid a lot of the things that are the setbacks. I wrote another book called What Would the Rockefellers Do?, which is about how do you create generational wealth and pass on not just your financial assets tax efficiently, but your non-monetary assets like your values and philosophies, and have that distilled for future generations, so there's signposts that they can actually abolish entitlement and have real purpose, so that they don't need to inherit the money, but they're fit to inherit it so they can actually grow it. And then I wrote another book as a co-author for 5-Day Weekend, which is how do you build the financial infrastructure to create enough cash flow that you manage that for 2 days per week, and then you have 5 days to create, build, and grow whatever you want, and swing at the fences, know that you have the right financial structure to support you. So instead of having a 2-day weekend where people are exhausted and recovering, you only got 2 days where you maintain and manage and really appropriate the right things financially. And then you got 5 days that you can create, grow, improve quality of life, launch a business, whatever it might be. And it's a completely different structure than what most people are taught, because they're still in these antiquated rules from the assembly line, working from brawn instead of brain. And I think when people get enough economic independence, they have cash flow that covers, life expenses every day, then they can really grow wealth at a different level. But it's an emphasis on cash flow first.
So what's the name of that third book?
5-Day Weekend. I also co-authored a book called Portal to Genius. I mean, I don't normally I feel like I'm bragging like, hey man, I've written all these books. Please appreciate them. But I'm writing a book now. And I even wrote a book that we did a limited release called The Money Tree. So I really have found a strange fondness, and maybe I'm a sick individual, in writing. Like when I wrote Killing Sacred Cows, I was so bad at it that I brought on a co-author because I didn't like my writing. He was much more well-read and articulate than I am, but now I've actually caught up and I'm a decent writer finally.
Here's the selfish part of what I'm going to dive into. So just yesterday, I was talking to somebody, a good friend of mine, high net worth individual, and he was talking about conservation easements. And you have already touched on that a little bit. Can you dive into that just a little bit? Because I know, our President Trump, has used that to his advantage on multiple occasions. But what are conservation easements, and how can these benefit you?
Well, conservation easements are part of the tax arbitrage kind of structure. And let's say that you own a bunch of land and you have a cabin on it, but you never want to sell the other land, but you could develop it. Like I was just meeting with someone in Colorado, already has 30 acres that are already approved to be developed, but owns 500 acres. Well, he could actually, instead of ever having anything built on it, he can donate through a conservation easement the ability to ever develop that land again. He still gets to use the land. He can hunt on the land. He can hang out on the land. He can do whatever he wants. He can have, bonfires, you name it, and still gets to keep the housing structure that's already built. But because he gives up the development rights, he gets tax credits. Now, where this becomes especially valuable is if your land is worth something, like if you're in a place where a lot of development is happening. My wife has a friend that has a major, like a big old barn and built a little ghost town on a lot of land. Well, that land is starting to become Park City, essentially. I mean, we just watch the growth and development. So if they want to donate the development rights, they're going to be worth a ton right now because of this place called Promontory. But if it's in the middle of nowhere, nobody wants to develop on it, you're not going to get as much tax credit. But you need to know, once you make that donation, that conservation easement, you can never develop that property again. That's why you're getting the credits today. We just met with someone last week that owns a bunch of land in West Texas, and they're going to have it appraised because they think there's a lot of sand in the ground. If there is, other people in Texas need sand for their fracking. If that's the case, we just had someone that got a 6.5 to 1 credit because they have sand on their land and the appraised value by doing a conservation easement. Now, they'll never develop it. They'll never be able to put buildings on it or pull the sand out of there, but they'll get major, major tax credits, and they don't have to worry about all the extra human capital and brain damage of having people on there and digging and doing all that kind of stuff. So you got to determine what's more valuable to you. If you told a developer about conservation easements, they might want to like hit you in the throat. But for those people that never want to worry about selling the real estate or developing the real estate, it could be a great, great way to have a tax advantage. And there's other things like historical easements that are kind of a cousin to it, where you give up the facade of a building that's in a historical area and get tax credits for that, but you still get an office in the building, rent it out to other people. You just can never tear it down, and you have to protect some of the historical kind of, what viewpoints.
So are you able to buy a large piece of land, let's just say 100 acres, and then build a really nice $100 million mansion on it, and then, all right, I'm going to donate it to the point of where nobody else can develop it, and then that can be your conservation easement?
Yeah, it just depends on what would they deem the development rights to be worth. And I imagine that if you put a $100 million property on there, you're going to get a higher development criteria. But if it's in, once again, it depends on how much building's going on in the area, what those types of things are selling for, what the plots of land, once they've got curb and gutter and they're ready to build on, that's what really determines the value of that. I kind of feel like if you're not at least getting 3.5 to 1, it's probably not worth it. So, at that point, whatever you spent on it, you're definitely getting more back than what you spent. Once you get up to 4 to 1 or 5 to 1, you just got to make sure that the value is truly there when you're getting it appraised and when they're finding out what the development rights are worth. Like I had 10 acres. I was thinking, I'm having a hard time selling it. Maybe I'll just do a conservation easement. But, the initial assessment was, well, it's not worth it. I'm going to get more money just dropping the price and selling it. And so it's under contract and about to close right now. I just dropped the price and decided to sell it. So you kind of weigh out what it means to you from the bottom line with cash in hand, or what it means to the bottom line with not giving the money to the government.
Well, I think that's where having your team in place, you can say, all right, I have this 10 acres, what should I do with this? Should I use it as a conservation easement, or would it be more advantageous for me to lower the price and then just sell it and just cash out and we'll put that money somewhere else? So that's really what that team is for. And one of the things I wanted to talk about too is I've heard of people, with these types of, tax credits that you have, they can sell those tax credits to somebody else. So how does that process work?
Yeah, there's no doubt that you could work those kind of deals. Now, let me just back it up for 1 second and kind of give a little bit of context here. To me, the tax credits are did you make sure you did everything else first from your tax perspective? Did you pay yourself in a way that minimized your tax? Did you maximize your deductions, whether that was paying your kids and taking the Augusta rule, writing off maybe a home office, different things there. And then what else could you do once you've exhausted that? Once you've done everything there, if you still have major issues, then you look at some of these, tax arbitrage ideas, or if you've now got everything handled and it's worth way more to someone else to get the tax credits than it is to you, there are ways to handle that. You got to be cautious about it because some of the people that come in and buy those are like syndicates. And so all the things have to be in order and done properly. And I couldn't tell you the whole process of that, but that's where I would bring in my tax attorneys and say, is this completely clean? Because I don't fear an audit. If you do things properly, legally and ethically, it's above board and you're well documented, then an audit most of the time is going to be no big deal. Especially LLCs and S Corps are less likely to get the best auditors. It's usually reserved for C Corps. And I never go to an audit. I've been audited twice in my life. My tax team handles the audit. I don't go because if I don't know the answer, we have a problem. If they don't know the answer, we get time for them to come and ask me and we talk about it. So yeah, there are things that can be done that way. And once again, if you just do the framework that I talked about, you'll know what all those options are. And even in the first part of my framework that, build the team, I like to meet with them quarterly and brainstorm. Like I've got an office right now for Wealth Factory, which is, downtown Salt Lake. Then I've got an office for my intellectual property company that's in the basement of my house. And then I have another consulting and speaking company. I decided I'm going to put the office above the garage of my new cabin. And by doing that, when I put in certain things like, well, I might as well have a gym and there should be a membership for that. Well, that membership is just going to basically be benefiting, clients, friends, and family. But now all of a sudden I can write off all my equipment. Like there's just so much opportunity if you do it right. That's the exciting thing. Where people get in trouble is when it's not documented, it's not well thought out. They do it after the fact. They don't have a team that kind of makes sure that the narrative's proper and the documentation behind it. And I just think far too many people are scared and confused around taxes because accountants say, oh, well, I'm conservative, which most of the time means antiquated or reactive. Or they say, hey, I don't want to create a red flag here. And most of the time it's not a red flag. I mean, I don't do anything that's red flag. I do some yellow flag things. Like I have a captive insurance agency, which means I can put money in pre-tax to my own insurance company.
That was going to be my next topic to ask you about was the captive insurance. I want you to dive into that a little bit.
Yeah, it's a great reclassification strategy. It's risk management first and foremost, because as a business owner, I face risks. Some of those risks are either expensive to insure or there isn't insurance available. So most of the time I'm using after-tax dollars because if I'm an LLC or S Corp, it passes through, I pay tax in that year, and I'm using that after-tax dollar to insure things. Well, now that I put it into a captive, I have 11 things I can insure that are, important to my business. I did a feasibility study, and now I have my own insurance company to handle those things. I put the money in there. And then if I don't have the risk occur, somewhere north of 12 months, I can start pulling that money out as a capital gain, which is a lot lower tax than ordinary income. And, if I do have a claim, I've got the cash there. If the claim is bigger than the amount of money I have in my captive, I actually use reinsurance. 2% of all my premiums that go into my own insurance company, I do what every other insurance company does. I use reinsurance in case there's a more catastrophic event. And this is what's cool, Dan. When we insure the catastrophic, it's the cheapest insurance. When we insure the inconsequential, it's the most expensive to pay for, but the least important to provide for. So I insure the catastrophic, never the inconsequential. And I insure anything that would keep me up at night if it were to occur with big insurance dollars, big companies that I'm paying less than a dollar for a dollar of insurance. Anything that I wouldn't lose sleep over, I know I could get through. I handle through my own captive or I don't insure at all. And by doing that, it frees up money that you're wasting on insurance without sacrificing coverage. And it creates as a benefit, a way to reclassify your income and pay less tax. Now, some people have been involved in captives that have been audited because they were done improperly. There wasn't feasibility studies. Some people even lost in court because of it. And this is why I waited 18 years from the first time I heard it to actually implement it. Now I feel completely confident knowing the firm I'm with, how they operate, what kind of things. And I even tested them. Not that I was testing them because I was trying to find out if they're doing anything wrong. I was just trying to invest my money differently than the restrictions that are required. And they just shot me down on all 5 of my what I thought were pretty cool ideas and said, no, you pretty much just got to put it in a diversified stock or bond portfolio. And I'm like, don't like the timing of that right now. So I'll sit in some cash. And if the right opportunity comes, my cash that's been in there for longer than a year, I'll pull it out, pay capital gains, and invest it where I want outside of the captive.
I'm sure the listeners are listening to this and they're going, how much of the bottom line do you have to be, how much of your AGI, let's look at that. That's probably even a better number. Of your AGI, how much AGI do you need as that adjusted gross income? For those who aren't familiar with that, how much of that AGI do you need to have to be able to go, man, I need to start implementing this and putting my team in place?
Look, if you can't put $300,000 away per year into a captive, don't mess with it. Because if you start looking at the expenses of setting it up and the time that it takes, you don't want to mess. You don't want to have to deal with, all that cost, and then it eats up whatever the savings were. And, at that point, either you need to boost your profits or you need to boost your revenue so you are more profitable. So at $600,000 of net income, you have almost everything I talk about is really available to you at your fingertips. Before that, as you're just starting out, you're probably you want to choose the right corporate structure. You want to maximize your tax deductions. You want to begin with your tax strategist and eventually get to your, tax attorney. As soon as you're at a, 350 and north net profit, net income take home, tax attorney time. Before that, a tax strategist will do just fine. And look, I'm giving a lot of information in a very short period of time. So I get you might be like, what are these terms that he's even using if you're not in the tax game? I mean, we all are in that we pay it, but not that many people that are weirdos that study it as much as I do. And that's cool because it's what keeps me in business, and I can help people out, and they can keep doing the things that they're very best at. So everybody, as soon as you start a business, you want a bookkeeper, even if they're part-time. If you're filing any tax, you want a tax strategist right from the get-go. As you grow, that's when the tax attorney or the engineer come into play, because a lot of times those first few years of a business, there isn't much tax to pay because everything gets reinvested and there's not as much take home for the business owner.
So what is it that Wealth Factory does to be able to help somebody that's in these types of situations?
We're great at helping people keep a lot more of what they make, and we've built an entire financial team. We have the Wealth Factory team, which is what we call financial architects and wealth engineers, to help you navigate every aspect of finance. Where you set, where you're not set, where's your blind spots, so that you make sure all your insurance are handled, your cash flow is optimized, you've saved on your taxes, you got the right credit score and portfolio banking, you've got protection on the downside and risk management with any investments, and then you've got enough cash flow to cover basic expenses. We begin there, and then we help people scale their business next. Now, we've got attorneys, accountants, investment advisors, cash flow specialists, risk management and insurance people that we don't own their firm, but we go through a criteria to accreditate them to say they understand who we are, our philosophies, what we do, and they're expert. They know the nuts and bolts and details to anything, so that they give everyone a second opinion and additional education that's customized and tailored to them. And if something's broken, they can actually fix it and do the implementation. So we work synergistically where we're the coaches and mentors, and they're the implementation behind it. So it's not just some transactional piece where you buy a product, or it's not just some coaching piece where there's not enough teeth to it to actually have it come to fruition in someone's life. I kind of look at it as we've got the Wealth Factory team and the accredited network working hand in hand. We're paid not by fees or commissions, fees on assets, or commissions by financial transactions. I call it a results-based tuition, where people write us checks and we make sure to put more than that back into their life through improved cash flow and implementing the methodology we're talking about. Taxes, one piece of it,
Have you ever had any of your, clients get audited and have to pay a bunch of money back?
I know of 2 times where people have owed money since 1998. One was, I can't tell you if it was our accounting team's fault or their accounting team's fault, because they were in the middle of transition when the audit happened. They owed just under $5,500. I'll tell you, we paid the bill. I wasn't sure, couldn't get to the bottom of it. And because I couldn't, I just paid the bill. Number 2, not my accounting team's fault, my fault. Early in my career, my early 20s, I met with a cop and he became a client. And I told him about selling the stock to pay off high interest rate loans, and it was going to free up a lot of cash and be a guaranteed return. And I forgot just in the meeting to tell him, well, you'd have to pay state tax. So he didn't. And that was like $1,000 or something. I paid it. Otherwise, about a third of the time, in weird years, up to 50% of the time, we actually save people money in the audit. Here's why. I'll give an example. I met a guy back in 2008 or 9, became a client, wasn't willing to have our tax team look at his stuff, but the person that referred him said, dude, Mike, is loving your program, but he says he's got the best tax guy in the world. So I called him, found out we were both Bears fans. I said, okay, so you get the best accountant in the world. He goes, well, I pay him. I asked for the most expensive. I really like him. I'm like, well, cool. Why don't you just meet with my guys? He goes, no, there's nothing you guys will be able to do. I said, well, if you'll meet with them and we can't do anything, I'll pay for a Bears game and I'll take you. And I said, but if we save you tax, you have to take me. And we agreed to it. And we went back 3 years, because you can amend 3 years back. We found $102,000 he overpaid. Then we went moving forward with the current strategy. He wasn't even incorporated, which you have a 400% increased chance of audit if you're not incorporated. So we got him incorporated with an S Corp. We paid him a reasonable salary and took the rest in distributions, which avoided self-employment tax, Medicare, Medicaid. Once that was maxed out, that saved him $10,000 a year. And he owned a building that he'd never cost segregated with an engineer. So we got that done. That was $11,000. So it was $21,000 moving forward and $102,000 looking back. Then 4.5 years later, he called me. We became pretty good friends. And he said, man, I'm going to jail. By the way, he took me to a Jacksonville Jaguars Bears game. It was crap. It was like in the rafters, and so I couldn't even see it. So he gets a letter that he's going to get audited. He calls me, tells me he's going to jail. I said, I'm not surprised you're going to jail. He goes, no, because I'm getting audited. I'm like, nah, you're not even going to go to the audit. I recommend people don't go to their audits. They send a tax team, because if the auditor asks a question that the tax team doesn't know, no big deal. If they ask you a question you don't know, that's kind of a big deal. And it starts to create suspicion. Well, he goes anyway. And I said, don't talk, but let's make another bet. If I save you money in this audit, you have to take me to a divisional game, and it has to be on the 50-yard line, lower bowl.
A little more stringent criteria now.
Oh, dude, I learned from my mistake, you know? And so anyway, we saved him $5,500 because the cost segregation we had the study showed the auditor, breeze, you know, showed him the corporate documents, why we were taking that amount of income, had it proved out because of what he was paying an associate. That was a breeze. Going back and amending, they already knew about the amendment. They are the ones that approved it and sent the check. So once that happened, we started saying, well, Mike actually got 2 vehicles. This one vehicle is really only used for business. We were being a little bit on the, I don't know, we just didn't have all the information from him, but he only uses it for business. We'd like to write it off fully. Great. Got that approved. Like, we're asking him questions right there on things that may have been too gray for us to take the first time. But now we're with the auditor where we can get it approved, which sometimes the auditor just ends the meeting quickly. Sometimes they just meet with you and you save them money. So that's maybe 1 in 3 times. And so not only do we not have issues with audit, we've gotten people a little bit of money back during audits.
So do you help somebody if they do get into that position of being in that audit phase?
Well, yeah, that's where the team that we've already helped them with. Like, I just spoke this morning on EO event where I had 2 people come up and say they've been in an audit for 2.5 years. It's been a bit of a nightmare. And I'm like, let's get you with a tax attorney that specializes in it and just have them come take care of it. You know, like, we didn't put them in that position. They're just coming up to me. That's not usually what we love to do or just willing to do it because it's a tough position of people for them to be in. If someone's working with us and then they get audited, our tax team is going to go do the audit. That's definitely what's going to happen.
So how does somebody reach out to you and try to figure out, you know, if maybe have a consultation with you or one of your team members to see if it's, you know, going to be a good fit for them?
Well, I mean, there's a couple ways to do that. They can go to wealthfactory.com/podcast. And we have some killer resources like the book that you mentioned, some really good tax resources on what they can do. So it gives them kind of like a little bit of teeth to what I'm talking about philosophically here. Or, I mean, they can even just grab one of my books, and I'm happy to have it be on my dime by going, hey, you know, they can just send a message and I'll get you a text number that we can put in the show notes. And once they text that number, then they can get that book. And then if they want a physical copy, they can pay for the shipping, and then they'll get the physical copy on me. And then if they want any video and audio resources, then they can even jump into that. But then those kind of things, they can get a one-on-one phone call, and we'll just investigate and comb through what they're doing and how it's working, and then figure out, you know, like where we could help. And maybe they come to one of our immersion programs. Maybe they hire us one-on-one. I mean, it just depends on the person's situation.
Yeah. And how long does that usually take for you guys to get that information and then, you know, do a review on it and then spit back what your, you know, maybe superficial level, you know, overview might be on a particular situation?
Like, a lot of times we don't even make them send anything for the initial overview. And then if they want to upload their taxes, we'll even look at those in addition to that. So they could literally be on the phone as soon as my guys can schedule with them. So probably 10 to 14 days out.
That's great. That's great. I love this topic. I love the tax strategies and the tax advantages. You know, even when you start talking about, you know, I do a lot of multifamily real estate investing with our company, HanfordCapital.com. And one of the things I always try to tout is the cost segregation, the tax savings of, you know, investing in these types of assets, because you know, cost segregation does cost money, and you have to have an asset that's worth a certain amount to really make it worth the return for the amount of money that you're paying for that engineer to do that cost segregation study. But it's amazing how it can change the returns on a high net worth individual when you start calculating the returns, like the IRR and stuff on a property. You can start to bake in some of the tax savings that these properties can provide as well.
Yep.
Well, thank you, Garrett, so much for being on the podcast with us today. It's been great. I love this topic. You and I could probably talk for hours on this, but I will definitely put it in the show notes and make sure your assistant sends me the little numbers, the code or whatever, to get a copy of that free book. And then we will make sure we put it in the show notes for our listeners and everything.
All right. I will definitely make sure that I'll probably get that to you right after this. I used to have the number memorized, but you know what? I don't give it out for memorization anymore, because one time I transposed 2 numbers And then someone got really mad that they were getting a bunch of text messages. so I'm a little bit more careful with that these days, you know?
Sure. Well, that's not a problem. We'll make sure we put it in the show notes. Is there anything that we maybe have missed or you wanted to touch upon that we weren't able to touch upon yet?
You know, it's always good to talk about tax. By the way, it's 801-503-9667. 801-503-9667, and then just text WWRD. WWRD. That is going to get you that book. Like I said, the download's on me. If you want an actual physical copy, pay for the shipping and handling. We'll ship it out to you. So, you know, if you like to, I kind of like to have the thing in my hands versus on an e-reader. And then we have some other cool resources that way. But look, I believe we don't get a second chance to build a life we love and create a legacy that lasts. I'm here to change people's financial future and their financial destiny for their family by abolishing entitlement, helping them pass on their non-monetary assets and become economically independent so that the best version of who they are is moving forward without finance and money plaguing their decisions where they say, I would do that if or when, but instead get that within 3 to 7 years rather than waiting for 30 years, hoping that it's going to work out. So it's a lot more strategic methodology. And I love teaching people what the ultra affluent and wealthy did to preserve, protect, and perpetuate wealth, like what the Rockefellers did, you know? And so that's a big part of what we teach as well.
You are so awesome, Garrett. I met you, and we talked about this in the green room. We met each other when we were at a mutual friend's house over in Park City, Utah. And That's where I first was introduced to you and just really, really connected with you, what you were talking about. I'm glad you're able to take the time to be on the podcast with us today and look forward to continuing to follow you. And you will hear from me. I'm going to have you look at my stuff, and maybe we'll have you back on another episode in the future to maybe talk about some of the things we were able to do with my stuff too.
Would love to, man. Yeah, hit me up. We'll make sure to do a review for you. That'd be great. And look forward to being on this again.
All right. Sounds great. Thanks so much, Garrett.
Have a great day.
Thank you for listening to the Tough Decisions Network. Be sure to visit toughdecisions.net to gain access to show notes for this episode and to join our free weekly entrepreneur email where we will send you news about the latest technology for your business, inspiring quotes, and the latest books for entrepreneurs. That's toughdecisions.net.